Welcome to Financial Freedom with the Flipping Flanagans, where we help real estate agents and already successful business professionals create legacy wealth through real estate. We go by the Flipping Flanagans, and we don't actually flip houses very often. When you drop the F-bomb a little too often, add that to a real estate background, you get the Flipping Flanagans. We actually buy property to hold and see long-term gains protected from inflation while seeing amazing benefits from appreciation and depreciation. See you on the other side. All right, welcome back. I'm Jamie Flanagan, and today we have our guest speaker on, Doug Morris. He happens to be our CPA. He's helped us a lot in our business, and I do have Brad Flanagan on the line as well. So we're all here together, and we are going to ask Doug a few questions that come up quite a bit, and there's a lot of confusion around some topics like 1031 exchanges, active and passive income, and we're just going to ask Doug and pick his brain today. So let's go ahead and get started. Hi, Doug.
Hi, Jamie. Hi, Brad. Thanks for having me.
So we
Glad to have you, sir.
Doug a lot. We are a messy. We have several LLCs, and Doug helps us navigate all of that on the tax side of things. And so, Brad, I'll kind of lean on you because you and Doug really communicate probably the most. So as we kind of go through this, maybe Doug even give an overview of like how you've helped us and, you know, what you saw from even our tax standpoint when we first came over to you and then where we're at now.
Sure. Absolutely. So yeah, Doug Morris here. I'm the Vice President of McFarlin Brokke CPAs. I'm also a shareholder at McFarlin Brokke CPAs here in Omaha. When you guys first reached out, you had some taxes that just need caught up, and we got to work in terms of helping with the real estate sale business, which is a form of non-passive income subject to ordinary income tax rates. And depending on how you're structured, potentially some self-employment tax as well as some rental ventures that you guys had been getting involved with. And so on the rental piece of it, the tax implications that may have come into play were twofold. First and foremost, buying and renting properties generates inherently passive income. However, there are certain participation requirements that may make that income non-passive. Being a real estate professional, materially participating in the activity are ways by which we can have that passive income recategorized as non-passive. That was a piece of the puzzle. And the other piece of the puzzle ended up being property with the intention of being flipped, which would then recharacterize the properties themselves as inventory and the inventory to be resold as ordinary income, since the purpose of the business is no longer buying, holding, and renting, but basically picking up products to be resold, your products being the housing inventory that you were purchasing. So between real estate sales, between financing the properties, between renting the properties, and between flipping the properties, we've got ordinary income, we had some self-employment income, we've got rental income, we've got inventory. And so just having an open line of communication and understanding what's going on is how we got to work and started working on the tax returns.
Right.
Yes. And I remember our first meeting sitting down and just having like a aha moment of, you know, this is how we've been doing things. And as we grew, you have to adjust. And something that we talk about kind of in our business on a regular basis is a lot of people want to stay comfortable. So they get to a point and it's like, now that this feels good, I just want to keep doing what I'm doing. But really navigating how to grow. And what I really like about Doug is him looking at the future and saying, if this is where you guys are going, here's how we put a plan in place to make it happen. More of a proactive approach versus a reactive approach.
Absolutely.
And Doug, I think you probably get a lot of questions about organizational structure in general. So the average entrepreneur or business owner, self-employed person likely doesn't know the difference between a partnership versus an S corporation, which are, I guess, more common ways to set up the business these days, versus just a sole proprietorship pass-through entity. which is primarily there to maybe mitigate risk because it's still going to count on your personal return. And then what was the most enlightening thing to me, I would say, in the years that we've been organizing business was really the debt basis issue and how that worked with an S corporation. So I don't know if it's worth kind of talking about that, but what I would like to at least communicate to anyone who's considering this is also informing your CPA how you operate. Like if you're going to be using cash versus credit and banks, like that part of your business plan will ultimately, I think, determine how you set up your corporation or your company.
Absolutely. Absolutely. I couldn't agree more. And so I'll hop right into a lot of the different components that affect the tax industry as it relates to real estate specifically. I'm going to take a breath.
Maybe get a glass of water.
Get ready for you guys to let me ramble, basically. So feel free to chime in as I go. But one of the immediate things that I like to do when I sit down with folks that are getting into real estate, first and foremost, is to determine the purpose of the entity and the purpose of the business getting involved. Real estate sales specifically. So Jamie, you being a real estate agent, you will be generating ordinary income. You know, you make commissions off the sales of homes. So as a result, I would tell you that the income that you generate is not treated the same way rental income would be treated. Now, more specifically, what that means is this: if you are a sole proprietor doing your own thing and you have real estate commissions that you're generating through the sales of homes, you are subject to your ordinary income tax rates on your personal tax return. But because you're considered self-employed, you're also subject to what's called self-employment income or self-employment tax. And so self-employment tax is the equivalent of Social Security and Medicare. And if you've ever been paid on a W-2 or as an employee of an unrelated business, you might see that Social Security and Medicare taxes are being deducted from your wage. What a lot of folks do not realize is that the employee only pays half of Social Security and Medicare. Collectively, that percentage is 7.65%. Your employer then actually has to match the other half and pay another 7.65% for a total of 15.3%. When you're self-employed, you are considered your own employee and your own employer. So you have to pay both halves of Social Security and Medicare, or that entire 15.3%. So when you're Jamie Flanagan owning a real estate business, doing your own thing, you will be subject to both ordinary income, which is just your ordinary tax brackets, plus this self-employment income. And since you are your own employee and your own employer, you're paying an extra 15.3%. Now, structurally, if you set up a different business, so Jamie, in your case, instead of doing business as Jamie Flanagan, creating big picture real estate, you then have created a separate business entity that then will dictate the type of tax return that you file and the type of taxes that come up. So there's a ton of different options. More common ones that I find in the real estate world are LLCs, S corporations, and C corporations. I'm not a huge advocate of C corporations. I won't touch a whole lot on those unless you have folks that chime in and will ask for that. But a lot of the structures that come up are, you set up an LLC. If you're a single member LLC, the IRS considers you disregarded. And so you file your tax return in the same way you'd file a sole proprietorship. You're subject to the same ordinary and self-employment taxes. If alternatively, you've got that same single member LLC, but you file what's called an S election to elect tax treatment as an S corporation, your income is no longer characterized as self-employment income. So it's no longer subject to self-employment tax. You just have to pay the ordinary income tax. If you're a multi-member LLC, the default tax filing is that of a partnership. There technically is no LLC tax filing. And so as a partner in a partnership, the ordinary income that you would generate off real estate sales would, similar to a sole proprietorship, be subject to ordinary income tax and self-employment tax. However, a multi-member LLC can also file an S election and allow you to be treated as an S corporation all the same and eliminate that self-employment tax yet again. There are a lot of different tax restrictions and unintended tax consequences that come from setting up any type of entity, whether you file an S election, file as a partnership, or sole proprietorship. And so I would say to consult me or another CPA to actually understand what that means for your personal tax return. But that's one facet. Go ahead.
Which, that's the thing. Everybody runs their personal life or their business life differently. And so we'd have to stay somewhat broad in order to deliver information that could at least be applicable to everybody. So I think the average person that might come across this is either going to be a real estate professional who has an interest in maybe building a real estate portfolio on the side, or a household who has some discretionary income at the moment and wants to continue to reinvest in their life and maybe get some rental properties going and see how that will work for them. Now, just because it's similar, it's close to a topic that I think is important. You hear a lot about 1031 exchanges, and the matter in which you hold title is likely going to impact what the documentation says for that 1031. So if I, Doug, own a property in 123 LLC and I decide I want to do a 1031, not yet sure if it's even worth it to do it, but let's assume I decide I'm going to do it. Do I have to purchase that next property, assuming it's a pass-through entity? Do I have to purchase the next property with the 1031 funds in the name of that LLC, or could I use my personal name when I take title to the next property? Is there anything that matters there?
No, that's a great question. And so I'll transition category or different business ventures in the real estate world. So the one that we were just talking about was for real estate sales, primarily those of real estate agents. And so I generally, when I run across a realtor or a real estate agent that's in the business of selling homes and doesn't necessarily just do it as a side hobby, but is generating some serious income from the business, it makes a lot of sense to sit down and evaluate what type of structure makes sense. And oftentimes an S corporation does make a hell of a lot of sense for that person, primarily through the vehicle of saving on those additional self-employment taxes, which, to reiterate, were 15.3% of your bottom line. So segueing to the rental piece of this equation, Brad, I'll touch on rental properties first and then get into the disposition on the latter half as it relates to the 1031 piece. So on the rental piece of this, for your listeners and you guys, which I'm sure we've talked before, and it may sound somewhat repetitive, but nevertheless, when you buy a rental property, there is a rule that the IRS has that if you buy a residential piece of property, you are allowed to depreciate that property over 27 and a half years. Now, if it's commercial, the useful life's 39 years. The IRS tax code is very weird to me, and that they, for whatever reason, decided that those were the amounts of years, 27.5 and 39, but we work with what the law says. Now, the benefit to depreciation is that homeowners that rent their properties may be generating positive cash flow. You know, if you collect, say, $2,000 of rent a month, and you've got your real estate taxes, your homeowner's insurance, your repairs and maintenance, interest on the mortgage, all of those expenses will be deductions that will offset that rental income. But you may still find that you're cash flowing, say, $300 or $400 a month, if not more. And you go, you know, I've got quite a bit of taxable income at the end of the day. You know, if I've got $5,000 of cash flow per property, and, you know, if I've got 10 properties, I might be making $50,000. Well, depreciation is very nice in that, you know, if you bought $2.75 million worth of real estate property, and it was depreciated over 27 and a half years. See, I picked a nice easy number for me to do the math.
I think I hear a calculator in the background.
Then you get $100,000 depreciation deduction. So, if you've got $50,000 of income minus that $100,000 of depreciation that most folks did not even know that they could write off because you're still making the mortgage payments, but you've got it financed. Or, even if you bought it outright in cash, you absolutely could still write off the depreciation. The depreciation is a nice way to help offset what you would have thought was taxable income. So part of the reason I like real estate so much in my world is that depreciation can help offset taxable income. So you're building equity, you're generating cash flow, and again, depending on your own personal circumstances and tax filing, but you potentially could be receiving that income on an annual basis tax-free. In regards to depreciation, I should disclose at least that the IRS, when they allow you to depreciate the property over its useful life, they do require that you allocate a portion of that property to land versus the actual dwelling. The dwelling is depreciable, the land is not. But anyway.
So question on that.
Sure.
When we buy condos, how do we determine how much land is it?
Your local assessor's office will have some sort of allocation to what the actual plot is worth. It's typically the easiest way to figure that out. So great question. And it comes up quite a bit. The safest answer is that we rely on the assessor to give us that answer. And it's public information typically.
If there was an appraisal that determined the lot lines were different or something, does that ever come into play?
Sure. So an appraisal or even a cost segregation study is a nice topic to introduce as part of this conversation. There are actually companies like appraisers and companies that specialize in cost segregation that say, if you bought, let's say, an apartment building and you didn't want to depreciate the entire thing over 27 and a half years, you wanted to accelerate the depreciation. Well, a company that could come in and do an appraisal or do a cost segregation study could isolate what they believe the land was worth, what the dwelling was worth, and take it even a step further, go into the house and determine if it was furnished, how much the furnishings were worth, if there were fixtures on the wall, determine how much of that purchase price was allocable to the fixtures. And the reason for isolating those is that the less you allocate to land, the more you can depreciate. The more you allocate to the furniture and fixtures, the useful life of those items is 7 years. There's also an election under Section 168K of the tax code that allows you to take what's called bonus depreciation on furnitures and fixtures that allows you to basically write it off in the year you acquire those specific assets. And so the more that you can allocate to depreciable assets and depreciable assets that depreciate quicker, the more tax savings you get now. Admittedly, that means you'll have less depreciation later, but the name of the real estate game typically is that cash is king, and the more cash I can save now, the quicker I can build my wealth now.
Right.
So accelerating depreciation tends to be the best way of keeping your cash and using it better now and letting the real estate world do its thing, compound and make more money.
Yep. And for everyone listening go ahead.
Well, before that, you go ahead, Jane.
I was just going to say a lot of people know that we do Airbnb or furnish short-term housing for like travel nurses. And recently we did a full building. And we haven't done our taxes on that one yet, but it'll be interesting to kind of navigate that as we just talked about this, because everything in that building is brand new, from the appliances to the furniture, a lot of the furniture, I should say. But it's interesting because that's a huge part of the cost that went into it.
Oh, sure. 100%. Absolutely.
And Doug, depreciation's often, at least in our world, referred to as a phantom expense. So
correct.
It's just
It's just a deduction that you get that you didn't have to spend any money to get.
Yes.
Perfect.
So on the
Thank
loan
you.
side, Brad, I'm going to ask you a question because I think this just from, go ahead.
Well, so with two parts. One, Doug, if I did that, say like that cost segregation, which is going to be also not cheap.
Correct.
And I decided to, maybe this was a flip and I just didn't do all the research, and I decided to try to take the depreciation. It's a big job. It took me a year to do the renovation, and I sold year 2 after taking 100% of that bonus depreciation year 1. Is there any ramifications to that?
Yeah, there absolutely. So depreciation, and again, the tax code keeps me employed with how complicated it is. I would tell you that post 1986, there were tax bills that were passed that say, if you depreciate your real estate over the useful lives that they require you to do, and so there's no flexibility here, but if you depreciate your residential property over 27 and a half years, when you go to resell it, the depreciation will increase your gain. However, it's all capital gain. And as a result, capital gains are allowed to, or capital gains in general have lower tax rates than ordinary income. And so capital gains are great in my world just because the tax rates are so much better. When you accelerate or take bonus depreciation on furniture and fixtures, the depreciation yet again will increase your gain. However, to the extent that you took bonus depreciation instead of this rental depreciation, you do have to recapture that as ordinary income, which is subject to higher tax rates. So there, in your specific scenario, Brad, I would suggest against it because you sold it very soon. And I imagine it would have been your intention to sell it in the short term. If it was a long-term play where your cash actually meant something right now, there you were able to save quite a bit of cash up front, then I would say, let's go ahead and accelerate bonus depreciation. But as a short-term play, you're robbing Peter to pay Paul the next year, and you're out more to Paul than you saved with Peter.
Perfect. Thank you.
Absolutely.
And then same goes for us. I guess that's the whole reason that we have loan officers. It's the same. It's probably not as complicated, but mortgage guidelines still have us employable as loan officers. So depreciation, which everybody wants to save ultimately on their tax bill. So you want to save money by having expenses. When you have something like depreciation, that is 100% add back to the income calculation, at least from a traditional mortgage standpoint. So if I have a contractor who purchases a $90,000 truck for their organization and decides because it's over 6,000 pounds, they can depreciate it at 100%. So they take a $90,000 expense. I still get that. They still get $90,000 worth of income in their application for a new mortgage, which is a lot better than repairs and maintenance being $90,000 or mileage being written off because you only get 50% of your mileage added back into your income calculation for stuff like mortgages.
Yes, and I absolutely love depreciation for the same reason. I am typically the bearer of great news when it comes to tax savings, but not so great news when people call Brad to get financing and we've basically eliminated all of his income that Brad has to use to say, you can't repay this, you don't show any income on your taxes. Depreciation is one that I love to use so that Brad can add back that depreciation. And on paper, we get to show the IRS you owe very little, but we get to show the mortgage company that you can afford to get that property and continue to build that portfolio.
I think that's a huge misconception because we've had lenders tell people that they don't qualify. And it's really because the loan officer didn't understand the tax return and the benefits of being able to add that depreciation back in. And that's where I was going earlier. So I knew Brad would touch on it.
Absolutely.
But it's made really important.
I will segue back here for a second to just rentals in general. Depreciation is a huge help because it will certainly help offset income from rentals. It can create losses in certain circumstances, but the passive versus non-passive loss rules are incredibly complicated. And generally speaking, if you're a real estate professional, you can treat them as non-passive, and to some degree, they can be uncapped. So what I mean by that is, if you have a vacant property or you start generating losses from rental properties and you meet the non-passive rules, you can actually start using those losses to offset your other sources of income. So, Brad, you generate a W-2 from your mortgage company. If you had rental losses of which we could prove you guys were real estate professionals that logged enough hours to meet the safe harbor regulations, all of a sudden we can classify you as real estate professionals, and those losses can be used to offset your other sources of income. People laugh and ask me, how does Donald Trump get out of taxes? And I tell people that he meets these rules. He gets to depreciate his rental losses.
Yep.
He gets to recognize rental losses by taking depreciation, and it helps him offset his other forms of income. There's a multitude of other reasons. That's one of the bigger ones.
Right.
But anyway,
I joke with people too about that, because it's like, we're not actually skipping out on taxes. We pay a lot of property taxes, a lot of employment taxes.
Absolutely.
We pay our fair share.
Well, and again, I'm employed to navigate the tax laws, and if I'm
Right.
a decent CPA, my job is to try to help reduce them.
Yes,
But-
the
And would you
ROI when
argue
you hire
the
Doug is
point?
amazing.
Thank you. What'd you say,
Again,
Brian?
yes. Well, so if you have a CPA, that is an investment because there is some sort of a return, right? If I pay you X and I pay less taxes by X times percent, I'm actually getting a return by paying you to prepare the taxes versus try to run through one of the online places and assume that they are going to be able to ask me all the questions necessary to do it right, or the risk it could incur by doing it wrong.
Oh, absolutely.
And
Brad,
then I would
remember
also argue I'm sorry, go ahead.
No, go ahead. Sorry.
I would just say I would argue the point too that the tax code is written in such a way that there are actually incentives to do business in accord with how our government wants it to be done. If the government has to provide housing, therefore being a government owned facility, the expenses are much higher than if it was a private company, because they have more process and procedure and due diligence that need to be followed to adhere to the requirements to like disclose to citizens, like just to have the website that shows here's full disclosure on the financials of this project because your tax money is paying for this. But now we have to employ more people and make it much more complicated. So instead, we're going to incentivize private companies and individuals to invest in real estate so that we don't have to. And then that's why you see things like when you have coronavirus, little stipends and grants and credits to the consumer who needs to pay their rent. They would much rather just give them a check so that they can pay us, who are willing to deal with all the headaches of owning and maintaining real estate, in order to keep the taxpayers happy. And
these tax laws were
government.
written by Congress through legislation. I mean, I joke sometimes that, I don't understand where they're getting 27 and a half years for how long a residential property lasts, right? That to me is an odd, unusual item of the tax code. But to their credit, a lot of the tax code does make sense. So this piece of the tax code, other than the real estate companies having the big lobby in DC, that it incentivizes home ownership, and it takes a lot of the work off the government's plate of owning the homes. So I couldn't agree more. I would say two other big items, and I know we're getting close, Jamie, here. So I would say two other big quick items for you guys that I haven't addressed yet that I said I would were debt basis was one that was unique and tax structuring. And then the other one was the 1031 exchanges. So I've talked quite a bit about rental losses, but are you even allowed to deduct them? Well, so the tax code says first and foremost that you need to be non-passive to deduct your losses. If you have passive losses, the only deduction you can take for them is to the extent that you have other sources of passive income, or they'll give you up to $25,000 if you make less than 100 grand a year. So to become non-passive, you actually have to be a real estate professional, and a real estate professional, that they strictly define it as somebody that will render professional services, and at least 50% of those services rendered during the year are in real estate oriented companies. On top of that, so this is an and requirement. So on top of that, they also have to log 750 hours in any given year. And that qualifies you as a real estate professional, but even then, that doesn't mean that your losses are non-passive. To be non-passive specific to the real estate activity itself, and in this regard, rental properties, there are material participation requirements, and there's actually 7 of them. But I'm not going to go through them all. Basically, you have to either have 500 hours logged, you have to have at least 100 hours logged, but you have to have spent more time than anyone else involved in the activity. You had to have at least met one of those 2 tests in at least 5 of the last 10 years. Or more vaguely, you have to have continuous, regular, or substantial involvement just based upon the facts and circumstances. So it's kind of vague, and there's quite a few options. Again, I tell you to consult your tax professional, but as soon as yeah, please and thank you. But if you meet those, now all of a sudden it's a non-passive loss that isn't restricted due to your other sources of income. You don't have to be under 100 grand. You don't have to have other sources of passive income, and you can deduct those now non-passive losses against, your W-2 income or other income you've generated during the year, except when basis comes into play. So what is basis? Basis is a wide variety of things, but more simply, money that you've invested into the company. So, if I invest $100,000 and let's say I just get my ass kicked year one and I borrowed 50 grand from the bank, I spent the whole 150 that me and the bank put in, I lost $150,000. Well, as a sole proprietor, as an S corporation, if I don't have basis, that is, it's not my money, I can only deduct the loss to the extent that I put money in. So if I've got a $150,000 loss, but I only funded 100 of it, I can only deduct $100,000. The other 50,000 I don't lose. It just rolls forward until I either generate profits, which I pay tax on, which increases my basis, which would then free up those suspended losses, or if I put more money in. Now, what Brad was alluding to earlier is that depending on the entity type. So if you're a multiple member LLC or a partnership that files as a partnership, partnerships are the only entity in the tax code that can actually use debt that they have personally guaranteed to increase their basis. So in my scenario, you put in 100,000, the bank puts in 50, but you've personally guaranteed that bank's debt of 50. Your basis is 150, and you can write off that entire loss. Again, there's 100 different factors that come into it. You're going to continue to hear me beat a dead record and just beat this record to death and tell you that your tax professional needs to be involved. But that's why.
Well, and that's really what we wanted to emphasize too, is so often something that we didn't know and we just learned the hard way, honestly. Some of the things you don't know what you don't know. So like when we first hired somebody and started navigating it, like they had one piece of advice, and then you meet with somebody else and they're like, oh, do it this way. So really like understanding and having like this open conversation over this so that people can hear this and then like be able to go to their CPA with a little bit of knowledge is what I think is super powerful about this conversation, really, because you should have a conversation up front and it'll save you a boatload of money in the long run.
Oh, absolutely.
We
And
think we're
practice
saving
what you
money when we
preach.
don't, yeah.
But, and I was just going to say, so practice what you preach. You know, I love real estate. I specialize in real estate investors. I also do quite a bit with professional services and a lot of trades as well. But, you know, I myself believe in rentals, so I own rentals. And so scouring the tax code isn't just for your benefit, but it's for mine as well.
Right. That was
So-
one of the criteria. I mean, I think we started with just anybody from a CPA standpoint, and then moved on to somebody who was more in commercial real estate. So there was a little bit in different business plan and organizational structure. And then that was how we ultimately decided to look out there and see what else was out there, and then came upon you, and you've got a lot of years left in you. You're not going, I don't think you're gonna, you might retire early, but that's just because you got us as your clients. I don't know.
Thank you.
Then, like you said, you have a network. You have, you know, maybe you can help connect people so that whatever you think you're saving by going and running through TurboTax or whatever, I've sent you fines letters I've got from the IRS in the mail that are equal to as much as it cost me for a whole year's filings, and then you've even gotten them to go away. So
it's just because I don't like the IRS. That's its own principle, right?
unless you work for the IRS and you're listening to this call, we love
right. Your penalties suck. You're a fine person, but the penalties suck.
yeah. And the hold times.
Right. Yeah, no kidding. But no, I'm a huge advocate of definitely keeping the right people in your circle. So, you know, you guys being in real estate, your realtor, your mortgage guy or gal, you know, having a nice attorney involved, your banker is important. If you diversify your investments and you are somebody that invest in the stock market as well, I mean, this isn't an all or nothing thing. I mean, your financial advisor could certainly help you evaluate how much to basically say, I want this amount to put in the stock market. Here's what you've got left for real estate, so that you know, cash flow is the name of the game, and cash is king in real estate. And so the last thing we want to do is an unexpected tax consequence. The advisor's got too much tied up in stocks. You're rich with real estate, but you're cash poor, and all of a sudden now you can't pay a bill. So cash flow is one of the biggest reasons why tax planning and tax structuring and keeping all these people in the loop is so important. I think the last piece really, and again, we could certainly dive into just more and more and more with the real estate piece of the tax code. I mean, there's hours of content there.
Right. I think we think we see what people ask too, and do a follow-up, you know, interview maybe in a couple months.
Yeah. After tax season would be great.
Yeah. I said I got
but-
lucky to get Doug on the phone at the end of the year.
Yeah, year-end tax planning is great too. And no, I appreciate you guys having me. But yeah, the last topic I'd say, and then I'll wrap it up, is just the 1031s. So one of the great things about the real estate tax code as well is that Section 1031, which is for like-kind exchanges, says that when you sell a piece of property, you can elect to pursue a 1031 exchange, and instead of recognize the gain and pay the tax on the gain, roll the gain into the next property, basically defer the gain down the road. Now, to complete a 1031 exchange, again, there are some strict requirements. When you sell the property to be replaced, you have 45 days to identify the property that you're replacing it with, and you've got 180 days to close on that property. During that process, you can't touch the money. You have to hire a qualified intermediary, usually a bank, to hold the proceeds and then reinvest them into the subsequent property. Now, you're deferring the gain. And so, if the replacement property you then sell and don't do a 1031 exchange, and let's say you've got a gain on that property as well, you've compounded your gain and there's going to be a large tax consequence. So it becomes a balance of, your tax professional is going to have to fill out more paperwork to disclose the 1031 exchange. You're going to have to pay the bank or whoever the qualified intermediary is to facilitate the 1031 exchange. And all you're doing is deferring the tax. And so if you recognize the tax sooner than expected, and it's not a long-term play, or let's just say the tax to be deferred is just insignificant, all of those would be disqualifiers, in my opinion, in which you would be worse off completing it. But if it's bigger, if it's a long-term play, if it's a way for you to keep more cash in your pocket now to reinvest and compound that wealth, then absolutely you should do it.
When I notice, like in this market, when people ask me and I'll run the numbers, and it's like, well, if you're going to overpay a property just to use the 1031, and you're, overpaying property offsets the tax benefit a lot of times.
Oh, absolutely. Absolutely it does. But, even continuing this 1031 road, under the current tax laws, there's a provision that says if you don't sell the rental properties at all, let's say you've got a family, you want to leave a legacy, upon death, there's a rule in the tax code called stepped up basis. And it says that upon death, your beneficiaries get a step up in the basis of that property to fair market value when you pass away and they inherit it. So what that means is, if I bought a property for $100,000 and it's worth $300,000, if I were to sell it, there's a $200,000 gain that I have to pay tax on. Now, if I die with it and my beneficiaries inherit it at $300,000, and let's say they sell it the next day for, say, $325,000, their basis is the fair market value upon my date of death, which is $300,000. If they sell it for $325,000, their gain is only $25,000. It's not $225,000 like you might think it would have been.
Right.
And so, again, you die with the property, you don't need the cash, you leave it behind to create a legacy. Or even more so, let's say you do want the cash, you could call your local mortgage guy, Brad, here, do a cash out refi, which is not a taxable event. You've got access to the cash, you die, your basis gets stepped up, the gain goes away, your beneficiaries get to inherit the property. They'd have to pay off the new loan, of course, but the tax consequence would be virtually nothing. And it'd be a great transfer of wealth without any tax implication. Again, it's why I love real estate, is the tax efficiency of it. Other things that we haven't touched on, and I'll hold off on, is just, qualified opportunity zones are a new thing in the tax code. There's quite a bit of tax incentives there if you wanted to invest in low income property. I could go on and on, but I would at least tell you that, to conclude at least my piece of this, there's a bill in Congress, the Build Back Better bill, that's actually been held up, and Congress is adjourned through the rest of 2021. And so it's not going to happen before the end of this year, but some items that were on the chopping block were 1031 exchanges and stepped up basis. And so the tax laws continue to evolve. You got to keep an eye on them, and not just the Build Back Better bill, but the CARES Act, the Secure Act, the Family First Coronavirus Response Act, the Tax Cuts and Jobs Act. I used to laugh that Congress didn't do anything. And then these last 2 or 3 years, they've passed a dozen bills, and now I'm like, slow down. So anyway, consult with your tax professional before you take any advice. And this is not advice, so please call that person.
Well, thank you, Doug. So if somebody were to want to get a hold of you here locally, or I don't know even what markets you expand out to, I know we're, local to you in Omaha, Nebraska, but how would they get a hold of you?
Sure. So I have a CPA license that's recognized in all 50 states and even internationally. I've got clients in Germany, Ireland, New York, California, all over the place, really. So my license allows me to practice beyond the borders of Nebraska. But you could reach out to our office number. Our office line is 402-341-9441. Or by email. Email is fantastic as well. My email address is dougm@mcbrock.com. That is DOUGM@mcbrok.com. You can also connect with me on like LinkedIn, Facebook, or give Brad and Jamie a call, of course, and ask them.
Yes, and I'll make sure his contact information is in the description. So you can click on the description and it'll take you right to him.
Yes.
So thank you so much, Doug. I really appreciate it. Thanks, Brad.
Thank you.
Thank you, guys. I appreciate it
Fun
as well.
adventure. I'm in Chicago, and you guys are in Omaha. It's all kinds of fun.
Yeah. The Midwest tends to have sporadic weather, so I guess enjoy the sun while we can. But yeah, it's nice chatting with you guys. I'm sure we'll talk again soon, and I appreciate you having me on.
Thank you.
Thank you so much for listening to today's episode. We hope you'll hit that subscribe button to stay in touch. Also, join our Facebook group at Building Legacy Wealth Through Real Estate to find out more about what we do and what we offer. Thanks so much, and we'll see you next time.